Okay, it's about 4 p.m. So let's get going. It's time to talk about the monetary policy report, October 2010. Those of us who are here are Per Jansson, head of the monetary policy department, and myself, Stefan Ingves. Welcome to all of you, and also welcome to those of you who are listening in wherever in the world you happen to be. Summarizing what's going on in the Swedish economy presently is basically this statement saying that the economy is growing rapidly. This is actually quite in line with developments already, the way we started talking about them in July and in September. And as far as we can judge, this process is continuing. Now, this happens against the backdrop of what's going on in some other parts of the world, which is not quite as favorably. And that's because things are moving more slowly in the Eurozone and also in the U.S. But on the other hand, given that we are a large exporter, one also should be mindful of the fact that global growth during this whole period that we're talking about here today is likely to be in the range of 4 to 4.5%, which is a very, very good number. And part of the positive story that we have to tell here is, of course, also part of that story for the world as a whole. And then against this backdrop, against what's going on in the Swedish economy presently, we have came to the conclusion that it's proper to raise the policy rate by 25 basis points, while at the same time, given the interest rate path that we publish, this process is likely to continue, but as far as we can judge presently, continue at a slower pace towards the end of the period, and that's mainly factoring into this what's going on in the large economies, because inflation is likely to be lower in the rest of the world. It will take longer than what we expected in the past for other rates to go up, and given that creates a bit of an interest rate difference between the Swedish krona and other rates, that could potentially also affect the exchange rate, which reduces inflationary pressures in our own economy. So now looking at this then, comparing Sweden to the euro area and the U.S., as you can see here, we had to take more of a hit when things were heading south. And again, this is because we are more dependent on, given the size of the economy relative to the rest of the world, we're more dependent on exports. But then on the other hand, now when global trade is coming back, as you can see, some of the negatives in the early days of this process have now turned themselves into positives, and that's why we have higher growth during almost this entire period, setting aside the fact that things sort of are gradually normalizing over time. And there are actually many good arguments for why this is the case. Contrary to some other places, we have strong public finances. World trade is up. Households look very positively at what's going on in the Swedish economy, and compared to some other countries, we do not have to go through a marked deleveraging process similar to what some others have to do. And broadly speaking, our financial sector is in better shape than some other financial sectors in the world. And then taken all together, this adds up to a very favorable scenario, and a favorable scenario where eventually it is actually where monetary policy eventually over time has to become less expansionary. If you look at consumer confidence numbers, and these have been normalized to make them more easily comparable, you can see here, looking at the red graph, that consumer confidence here is quite different actually compared to consumer confidence in the euro area and in the U.S. And also, as you can see here, where we are presently is quite close to and almost similar to the peak that we had back in 1999. So looking at this in a longer time perspective, we're talking actually here about a remarkable number given given what happened in the economy in the past few years. And this is, of course, then, as you can see here, quite different compared to the way consumers look at what's going on in the euro area and also in the U.S. Now, another factor that plays a role here is that, as you can see here, in our projections, we expect the government to be back in surplus over the next few years, which is quite different compared to some of the large economies that we have listed here. And that, of course, means that we do not have the same struggle with balancing the government's books, that we don't have the same problems with and debates about our debt to GDP ratio, because the debt to GDP ratio is fairly low compared to many other countries. And this also creates an environment where people know that this is the way things are. This creates more confidence in our system, because it's obvious that we will have less of a debate about how to correct things, because we don't have much to correct compared to these other economies. On the other hand, this also affects us, because what it means is that in the U.S., in parts of the Eurozone, in the U.K., countries will have to struggle with this for a number of years in order to eventually, over time, in one way or the other, balance their books. And going through that process, as we know from the mid-90s, that takes time, and it's not so easy to do, and it also tends to affect aggregate demand. Also part of this story is the exchange rate, and as you can see here, the krona weakened substantially in the past few years, as it tends to happen, given our position in the world and how others look at our economy. Now the krona has appreciated for a while. We expect that to continue, and we expect the krona to sort of end up in a territory which is fairly similar, actually, to where we were before the global crisis that so many of us had to deal with. Having said that, though, it's important to point out two things. One is that we have a flexible exchange rate with the exchange rate policy that we by now have had for many years. The krona moves up and down for all sorts of reasons. And that brings me to the second point, and that is that it is very hard to do exchange rate projections. And we have, over the years, many times said that we think that the krona is going to appreciate. Maybe this time we have a stronger basis, perhaps, for saying that than sometimes in the past. This is, as you can see here, a fairly traditional view when it comes to the exchange rate, being mindful of the fact that we have a floating exchange rate. Now, looking at the upturn in the Swedish economy a little bit more, as you can see here, if you look at the red graph describing what has happened with our exports, you can see there that you first have a very marked drop, and then exports continue to grow and will continue to keep growing over the foreseeable future. What usually follows from that is then investments going up. And as far as we can see on the investment side, this process will continue also during this period. And the same holds when it comes to consumption. But the blue graph, as you can see, is much less volatile, because the increase in consumption over this period is likely to be fairly stable. And also, I think that this graph also partly shows why things didn't get quite as bad as we expected things to end up during the downturn, because consumption stayed fairly stable during this difficult period. And then, in terms of what this does then when it comes to the labor market, this is what our view. Unemployment peaked at a level which is markedly lower than we expected in the summer of 2009. And as you can see here, we expect unemployment to keep falling and reaching a little bit lower than 7% towards the end of this period. And this is, of course, given the way we thought things would end up, a very, very favorable development. Another way of talking about the same issue is to take note of the fact that sometime fairly early next year we expect GDP to roughly be back at the same level as GDP was late 2007, and that was before things started unraveling in the world in terms of economic activities. This also means that if one tries to measure resource utilization, which can be done in many different ways, we'll be sort of back at a normal level within the time frame that we're talking about here. And then that's one more way of sort of saying that things by then will have normalized and also look compared to where we came from. And that means that we have then gone through kind of let's say a 3-year period, maybe roughly 3.5, something like that, during which resource utilization ended up being lower than normal, and during one period, as we showed when you looked at the growth numbers earlier, much lower than normal. Now then, translating all of this into inflation numbers, measuring it in CPIF terms, excluding interest rate payments on mortgages, as you can see here. Presently, we are fairly close to target, given that the exchange rate has appreciated, and given that wage increases have been very low, we actually expect inflation to fall in the near future. But on the other hand, given the demand conditions in the Swedish economy over the next couple of years, there will be enough inflationary pressure in order to make the inflation move up a bit, which implies that we'll be roughly on target towards the end of our or the time frame that we're talking about here. And then expressing this in CPI terms, including interest rate payments, one gets what one would expect to get, a CPI which is above target during this period, because here you have the interest rate increases included. But on the other hand, let's assume that the world stays stable ever after. Then these two graphs would over time pretty much coincide. So this means that in terms of the inflation forecast, we are fairly close to target. And in order to achieve this, we needed to raise the policy rate yesterday, and the rate hikes will continue, but not quite at the pace we thought about it in September. And you can see here there is a slight adjustment of the repo rate path towards the end of the horizon, and this is very much due to the weaker situation abroad and the lower inflationary pressures that we see abroad. And part of it is also the fact that there will be interest rate hikes are likely to be pushed more into the future than we expected in the past. And given that we are quite closely linked to what's going on in the rest of the world, both in terms of the real sector and in terms of the financial sector, this is likely to do its bit when it comes to judging what kind of repo rate path is the most suitable one in order to achieve our inflation target over time.